If you want to take money off the table at exactly the right time, without leaving tens of millions of dollars on the table, and without waking up after that wire hits and thinking, did I sell too early? Well, this might be the most important video you watch all year. In the next 10 minutes, I'm going to walk you through the two most important numbers that every business owner approaching an exit needs to be thinking about. Number one, what it actually costs to be you. Not a feeling, not a guess, one number. And the second number is where you sit on the multiple curve. Because that next step up in valuation tier could be the difference between tens and millions of dollars. If we had a chance to meet yet, my name is Luke Turner. I am the co-founder of Ramon Private Wealth, and we specifically help entrepreneurs who have outgrown traditional financial advisors. And I've personally helped navigate exits north of $100 million. I've seen the good, I've seen the bad, and I'm going to show you everything in between today. Here's what nobody tells you when you go to sell your business. It's much less of a valuation question and much more of a personal financial question. Too many business owners are working with generic financial advisors and don't understand the tax implications and the planning implications of walking through a multi-million dollar exit. If you're an entrepreneur that's worth north of $10 million, you're going to want to keep watching this video because these two numbers could be the difference in millions of dollars in your pocket. Let's dive in. Number one, what does it cost to be you? Now, on the surface, business owners think this is a simple question, but as you dig deeper, it's not so simple. Let me explain. When you started your business, chances are it wasn't making a lot of money at first. And then it started to make a little bit more money, a little bit more money, and a little bit more money. As you made more money, you talked to your accountant and they said you're going to have to pay all this money in taxes. And a common thing that I have found is that business owners then start running their personal life through the business. All those personal vacations that got put on the company credit card, the boat you bought, maybe the private aviation travel. Let's go ahead and run that through the business. That's a tax deduction is what they said. But what gets really convoluted is then you no longer know, if I no longer have this business and I'm not running these expenses through my business, what does it actually cost to be me? So the way that I would like you to break down your expenses is think about your fixed expenses and then your variable expenses. Your fixed expenses are going to be things like your mortgage payment, car payments, anything that recurs on a monthly, quarterly, or annual basis. And then I want you to think about your variable expenses. These are going to be the things that chances are you think about them in terms of one-time expenses, but they're going to continue happening because they've been happening for the last decade plus. Those family vacations you're going on, buying a new car, those are not one-time expenses. Those are variable expenses that just incur in big chunks of money. And so we need to be really conscious of what are we spending before we ever consider pulling the trigger. Because this personal financial question is going to allow us to back into what we need to sell our business for. Too many people start with the valuation first without understanding what it costs to be them. And why is that a massive mistake for the business owner watching this video? Well, if you sell your business, you can no longer get it back. And if you don't sell your business for enough money after taxes to support your lifestyle indefinitely, that can be a massive problem. Because then you can be in a situation where you no longer have your business, you no longer have your income, and you're going to have to go back to work or start a new business just to keep up with the same lifestyle you're living right now. As you're watching this video, you're probably thinking, well, Luke, that's great, but how do I know what my number is? That's what you told me you were going to get out of this. Let's take a look at it. The best way to understand this is just look at a real life case study. So what we have pulled up here is a $10 million exit, looking at our post-exit valuation, our deal costs included, and then showing you here's exactly how much money you could be drawing off that portfolio indefinitely without any business income. So let's go ahead and walk through this page. We have our $10 million headline sales number. We're going to pay $2 million in long-term capital gains at 20%. We're going to pay net investment income tax, which is another tax at 3.8%. And then we're going to have our deal costs in here at $250,000. These are going to be for our banker, legal, due diligence, things of that nature. And that's going to give us our net investable number right at $7.37 million. Now, the one number you might be thinking is missing here is our state income taxes. I'm assuming you're living in a no state income tax state. Easiest way to tweak these numbers, if you want to do that live, take the headline number, multiply it by your state tax rate, and then just reduce that by that net investable number. But back to our example here, we have $7.37 million of investable assets, which gives us roughly $30,000 a month or $368,000 a year that we can spend off the portfolio indefinitely. Now, you might notice that we have a tick up from our traditional 4% rule to our 5% rule. Why do we say that clients that work with Moment can actually spend more? Well, we have a unique way that we approach the investment management side of the portfolio, as well as how we actually take distributions off the portfolio that allows our clients to actually spend more money than working with that traditional financial advisor. So all this to say, if you have a $10 million exit you're going to be in a situation where you can spend roughly $30,000 a month, a great life. But you need to know that one number, which is, what am I spending? Because if you're spending $50,000 a month and we sell for $10 million, we're in big trouble. We need to make sure that we have the right valuation that matches our number. Moving on to our second number, we're going to be talking specifically about the valuation of your business. And again, we need to match our valuation of our business to the number that it costs to be us. And as we think about the valuations, the big topic that I see get missed for business owners is not understanding the multiple tiers and how multiples continue to jump up as companies continue to get bigger. For those of you that might be new to the exit planning stage or selling your business, what is a multiple? A multiple is where you're going to take your EBITDA, which, think about this as just your adjusted earnings, and you're going to multiply it by some sort of multiple, and that's going to give you the actual valuation. And again, that multiple is largely going to depend on how valuable the buyer thinks your business is. Typically, the bigger a company is, the more specialized it is, the higher the valuation is going to be. What I went ahead and put together is looking at manufacturing multiples. So these are for companies that are in the manufacturing sector. One note is that if you are outside of the manufacturing sector and you want a list of what multiples do look like, throw that in the comments below and I will send that over to you so you can know what the multiples look like in your specific industry. But for the sake of this conversation today, we're going to look at the manufacturing multiples. So we have lower Main Street all the way up to what we would call a platform company. So lower Main Street would be less than $1 million of EBITDA or earnings. And then our platform companies would be north of $15 million of earnings. What you can see is that companies that are around $1 million to $3 million are going to garner multiples between 4 and 5.5 times. So if we had $1 million of EBITDA at 4 times, that would be a company that's worth $4 million. But you can see if we have a $10 million company, so somewhere between this 7.5 and 15 million, we're going to get somewhere between a 7.5 and a 9.5 times multiple. So on $10 million of earnings, we might be looking at some valuation close to $80 or $90 million from a valuation perspective. And as I think about valuations, there's 2 problems that arise as you look at these numbers. Number one is that we didn't understand what our number was, and we sold the company for less money than what we actually need. And then the second is that we were really close to what we call multiple expansion or multiple arbitrage in our industry, and we sold our company too early. So when I think about selling the company too early, what do I mean by that? Let's look at a specific example in the manufacturing space. Now, this isn't just an example. This is something that I've actually seen play out in real life. Now, what you're looking at on this page is that multiple expansion issue that I was referring to earlier. As I think about multiple expansion, there are times where this can cost business owners millions of dollars, if not $10 million plus dollars, like you can see in this example. And what I can tell you is that I've seen this firsthand. And it's so unfortunate because too many times business owners get tied up with seeing a number, feels like a lot of money, and they just go down the path of selling because it's more money than they've ever seen somebody offer them. So before you do that, make sure you understand where you're at from a multiple expansion standpoint. Because in this example right here, we're talking about the difference in $1.2 million in earnings. So a lot of money from an earnings perspective, but certainly not unmanageable if you were at 2.8 million. So this example, we have a $2.8 million earnings company. So think about that as profits from the business. We're selling at a 5.5 times multiple. So our valuation is right at $15 million. But if we can just get our EBITDA up from 2.8 to 4 million, we're looking at potentially one more turn or a 6.5 times multiple, which would be $26 million. So that extra $1.2 million of EBITDA is actually worth $10 million. So as you think about reinvestments back into the business, how hard it's going to be to get that extra $1.2 million of EBITDA, all questions that need to be considered, but you need to be very aware and conscious of where you're at in that multiple arbitrage or that multiple arc, so you can be in a position that you're not leaving millions and millions of dollars on the table. Now, we've walked through our 2 numbers. What does it cost to be you, and where are we at with the multiple arbitrage or the multiple arc? If you have questions on those 2 numbers, not sure how to calculate them, want a professional look at it, you can schedule a call with me below, and I'm happy to walk through one or both of those numbers free of charge. And if you enjoyed this video, you're going to be enjoying more and more content that we're going to be putting out there. So please don't forget, subscribe to the channel below, and I will see you next time.